Hello and welcome. Today, we're going to delve into a topic that, while complex, is incredibly important: how to properly file a final tax return for a deceased taxpayer. Navigating the tax landscape after someone has passed away can feel, well, pretty overwhelming. There are special rules, some unique strategies, and a lot of responsibility. The whole point of this explainer is to really demystify the process and give you a clear, structured guide, whether you're a student, a professional, or someone who's been tasked with this important duty.
All right, let's dive right in. The best place to start is with the central figure in this whole process, the legal representative. So, who is this legal representative? Well, you probably know them by another name, like an executor, that's if they're named in a will, or an administrator if they're appointed by a court. This person or institution is legally in charge of the deceased's estate. And what's so critical to understand here is the sheer weight of this role. It is not just about paperwork, it's about making sure every single tax obligation is met. Because, and this is the key takeaway, if they're not, that representative can be held personally liable for any taxes the estate owes. That personal risk is precisely why getting this right is absolutely non-negotiable.
So, what does this job actually entail? You can think of it as a 4-step mission. Step 1, file all the income tax returns that are needed. Step 2, pay any and all taxes owed, both income tax and GST/HST. Now, step 3 is the big one for the representative's own protection. Get a clearance certificate from the Canada Revenue Agency. This document is basically the CRA's official word that all tax debts are settled. It's what allows the representative to distribute the assets to the beneficiaries without that fear of personal liability hanging over their head. And finally, step 4, they need to let the beneficiaries know about any income they might have to report on their own tax returns. Now, before any of this can happen, the CRA has to officially recognize you as the legal representative. It's not automatic. You have to provide 2 essential documents: a copy of the death certificate and a copy of the legal document that gives you authority, which is usually the will. Let me be clear, without these, the CRA won't share any of the deceased's confidential tax information. The whole process will grind to a halt. Okay, so we've established the who. Now let's get into the how. A person's death actually triggers a whole set of unique tax rules. And interestingly, many of these rules are actually more generous than the ones for living taxpayers. Understanding these is absolutely key to minimizing the tax bill for the estate. Let's start with charitable donations. Normally, the tax credit you can claim is capped at 75% of your net income. But in the year of a person's death, that limit jumps all the way up to 100% of the deceased's net income. And this isn't just for donations made during that final year, it also applies to gifts left in the will. That is a massive enhancement that can create some really significant tax savings.
Here's another great example of these special rules: medical expenses. Typically, you claim expenses for a 12-month period that ends within the tax year. But for a final return, the representative can claim eligible medical expenses for any 24-month period that leads right up to the date of death. This longer window provides a ton more flexibility to capture major medical costs you otherwise might not be able to claim.
All right, this next one is a big one: capital property. Generally, when a person dies, the tax system triggers what's called a deemed disposition. This means everything, stocks, real estate, you name it, is treated as if it were sold at its fair market value right at the moment before death. This can trigger a huge capital gain. But there's a really powerful exception called the spousal rollover. If property is left to a spouse or common law partner, it can be transferred at its original cost, which defers the tax. And even better, if there are capital losses in that final year, they become incredibly flexible. They can be used to offset not just capital gains, but any type of income, pension, employment, anything, in both the year of death and the year right before it. So we've seen some of these special rules, but now I want to talk about the single most powerful tax saving strategy of them all, and that's the ability to file more than one tax return. Now, I know that sounds like a headache, but trust me, this is where the real planning opportunities are.
So that begs the question, right? Why on earth would you want to file more tax returns? Well, the answer is found in the very structure of our tax system.
You see, the Income Tax Act actually lets a legal representative file several optional, or what we call elective, returns. The most common one is the rights or things return. This is for income that was earned and owed to the person but just hadn't been paid yet when they died. There are others too for specific cases like business income or income from a trust. Each one of these returns essentially creates a brand new, separate taxpayer for just that slice of income. So what exactly are rights or things? Let's make this more concrete. Think about a salary for a pay period that ended before death, but the paycheck arrived after. Or maybe bond coupons that had matured but hadn't been cashed. Or even dividends that a company had declared but hadn't paid out yet. These are all amounts the person had a legal right to receive.
Okay, let's walk through a practical case study to see why this matters so much. Meet Mr. Rosen. He was a business owner, and his business year ran from July to June. He passed away in November of 2025. Now, without any special rules, his final tax return would have to include a full 12 months of income from his last business year, plus the income from July to November. We're talking about cramming almost 17 months of income into a single tax year, which would push him into the highest tax brackets. The solution? His executor files an elective return for just that short period, from July to November, perfectly splitting the income and avoiding that massive tax hit.
So here's the bottom line. The main benefit here is all about taking advantage of our progressive tax system. Each separate return that's filed is treated like a brand new taxpayer, which means each one gets its very own set of graduated tax brackets, starting right back at the bottom. And this chart really brings it to life. Let's say you've got $115,000 of income. On a single return, a big chunk of that gets taxed at higher rates. But if you can split that income across two returns, say $57,500 on the final return and another $57,500 on an elective return, you get to use that low 15% federal tax bracket twice. The total tax bill drops significantly. It's a classic income splitting strategy. And as if that wasn't already a great deal, there is a second major advantage. Certain personal tax credits, the ones that reduce your tax bill dollar for dollar, can be claimed in full on each of the elective returns you file, not just once, but multiple times. So, just to recap, we can multiply our use of the low tax brackets, and we can multiply certain tax credits. This naturally leads us to the next topic. How do we strategically apply all these credits and deductions across the returns to get the biggest tax savings for the estate? Now, what's really fascinating here is the list of credits you can multiply. We're talking about the heavy hitters, the basic personal amount, the age credit, the spousal credit, caregiver credits. These can all be claimed in their full amount on the final return and on each elective return. So if you filed 2 extra returns, you could claim the basic personal amount 3 times. The savings can easily add up to thousands and thousands of dollars. Of course, it's not a free-for-all. Not every credit can be multiplied. The rules are quite specific. As this table shows, some credits, like medical expenses and donations, can be split any way you want between the returns. Others, like the pension income credit, have to follow the income. They go on the return that reports that specific pension income. And finally, some big deductions, like for an RRSP contribution, can only be claimed on the main final return. It's all about strategic allocation. We've covered the strategy, which is the fun part, but execution is just as important. And that means paying very close attention to these strict deadlines for both filing the returns and paying any tax that's owed. As you can see, the due dates for the final return really depend on when the person passed away. If death occurs anytime between January 1st and the end of October, the due date is the familiar April 30th of the next year. But if the death happens in November or December, the representative gets a bit more breathing room. The return is due 6 months after the date of death. And that elective rights or things return, it has its own, often later, deadline, which gives the representative time to see the results of the main return before deciding if it's worth filing. And that brings us to one final, incredibly valuable provision. The tax bill from a deemed disposition or a rights or things return can be huge, and it can create a real cash flow problem. The Tax Act provides some relief here. The representative can choose to pay this tax over a period of up to 10 equal annual installments, as long as they can provide some security to the CRA. This can be an absolute lifesaver for an estate that is rich in assets, but short on cash. So, we've walked through this maze of complex, but often quite advantageous rules for a final tax return. And this brings us to one last crucial thought. If we can see all these powerful strategies available after death, well, just how much more powerful is proactive estate planning done before death? Thinking about these rules ahead of time and structuring your affairs accordingly might just be the greatest gift you can leave to your executor and your beneficiaries.